Welcome to Lecture 1. Lecture 1, this is Dr. Ta. We are talking on financial statement and business decisions. Financial statements and business decisions. In this chapter, we are going to go through the four major financial statements. We want to start by understanding the business. Businesses are owned by stockholders. They are owned by stockholders. Stockholders actually buy a certain percentage or fraction of the business. They anticipate a potential return in the future. They make return through dividend yield, which is the payment of dividend. When they receive dividend, that is how they make return. Additionally, stockholders can also make return through higher future stock prices. That is what we call capital gain. Capital gain is the appreciation of stock prices. For example, you buy a company at $10 per share, and 1 year after, prices appreciate and that company is selling for $15 per share. If you liquidate your position, you are able to make roughly about $5 per share. So that is capital gain. So in addition to stockholders, we also have creditors that lend to the business. Their potential return will be interest. They are looking at interest, which is fixed periodic payment for the time of their investment. There are two types of accounting system. So these are documentations that provide disclosure and report about the company, and it target different decision makers. So the first financial statement, accounting statement, is what we call the financial accounting report. The financial accounting report is disclosed periodically. So it's a periodic financial statement and related disclosure. And this statement actually targets external decision makers. So it is prepared and reported to external decision makers. It helps them to be able to evaluate the company. They can evaluate the company. They can make decision whether they should invest in that company or not, whether it's a good company for them to do business with or not. Such external decision makers will include people like creditors. If you want to lend to a company, let's say a bank, for example, they want to see the financial accounting report, whether that is a good company to invest into or not. Also, potential investors and even current investors want to look at the financial accounting statement. So investors are generally interested in the financial accounting statement. In addition to creditors and investors, suppliers are external decision-making bodies, making decision makers. They want to be able to know if that is a good business that they are working with. Customers are interested in financial accounting report. Union representatives, the government, other people are interested in the financial accounting statement. We also have what we call the managerial accounting report. The managerial accounting report is a detailed plan and a continuous performance report. It is designed for internal decision makers, those who run the company. These are people like managers that run the company. It helps them in making decisions that are related to things like pricing. How do they price a product or price the services they offer? It helps them with production. It helps them with quality management, and so on and so forth. So the broad two accounting systems is the financial accounting report that is made for external decision makers, and we have the managerial accounting report that is made for internal decision makers. Within the business, there are different business activities that takes place. We talk about three of them. The first one is what we call the financing activity. The financing activity is basically how companies get money to finance their operation. How do they get money to run the company? So it could be through borrowing money from the bank. So in that case, that will be debt financing. So they are getting money through the issuance of debt. Well, maybe something like issuing bonds. So they'll be getting money from the public. So that's financing activity. Companies could also get money through equity financing. So in that case, they'll issue stocks or what we call shares. So everything that is debt related, equity related, that goes on in the company, that is financing activity. Companies also have investing activity, which is how they invest their money, the buying and selling of equipments and plant. So all of that are investing activity. They are investing. In addition to that, there is operating activity. So by operating activity, it is simply the day-to-day operation of the business. The buying and selling of merchandise to customers, paying suppliers, collecting cash from customers, delivering products and services to customers. All of those are operating activity. Now we introduce ourselves to the four basic financial statements. They include the balance sheet. The balance sheet reports the amount of assets, liabilities, and stockholders' equity of an accounting entity at a point in time. We need to take note of that word, at a point in time. So the balance sheet is simply a snapshot of the company at a particular point in time. It could be the day of the year, usually the end of the accounting period. The balance sheet will always captures all the assets, all the liabilities, and the stockholders' equity of that company. We also have the income statement that reports whether the company makes a net income or a net loss. If it's a net income, the company is profitable and is for the entire accounting period. If it's a net loss, then the company is unprofitable for that accounting period. So accordingly, the income statement will report all revenues, and all expenses. So we are going to take revenues minus expenses to know whether the company makes an income or not. We also have the statement of stockholders' equity. The statement of stockholders' equity reports the changes of each of the company's stockholders' equity account, and that includes changes in retained earnings balance that is caused by net income and dividend during the year. So there are two major stockholders' equity account. It is common stock and it is retained earnings. Common stock is the amount that stockholders have invested in the business, and retained earnings is the earnings that the company has made for that year, but instead of distributing that earnings to stockholders as dividend, that earnings is retained. So the changes in retained earnings and common stock is reflected in the statement of stockholders' equity. The fourth financial statement is the statement of cash flow. The statement of cash flow actually reports all cash inflows and cash outflows during the accounting period. And the statement of cash flow is usually categorized, or they are placed in three categories: operating, investing, and financing. So it's going to capture cash inflows and outflows from operating activity, cash inflows and outflows from investing activity, and cash inflows and outflows from financing activity. We'll look at this statement one after the other. So the first one is the balance sheet. What we find here, they are the elements of a balance sheet. The balance sheet again is a snapshot of the company's financial position at a particular point in time. It will include the assets, it will show the company's liabilities, and it will show the company's stockholders' equity. So the assets, usually they are arranged from the most liquid down to the least liquid, cash itself being a liquid asset, and then other assets that are very near cash. So these are examples of assets. Assets are economic resources, which implies that they have an economic benefit to the company. So an example would be cash. Cash is an asset. Short-term investments, they have benefits to the company. That would be an asset. Accounts receivable is an asset. When the company sells on account, they sell to a customer with a promise to pay, so they're expecting benefit in the future. They will record that transaction as an accounts receivable, so that is an asset. Notes receivable is an asset. Inventory to be sold is an asset. It has future economic benefits. Supplies is an asset. Prepaid expenses is an asset. It has future economic benefits. Long-term investments is an asset. Equipment is an asset. Building land, intangible assets. So on the balance sheet, we are going to have a list of all the assets that are owned by the company. And on the other hand, we'll have liabilities. Liabilities are the debts or the obligations of the company. We have different liabilities accounts payable. When the company buys on account, they buy with the promise to pay. So they are owing somebody, they have a debt, they have an obligation. So when they buy on account, that will be documented under accounts payable. Accrued expenses that were supposed to have been taken care of, but it has been pushed down in the future. That is a liability. Note payable, taxes payable, unearned revenue, bond payable. Those are examples of liabilities. Then on the balance sheet, we also have the stockholders' equity. Again, it comprises of common stock and retained earnings. Common stock is the amount that investors have invested in that business. They are financing that are provided by the owners of the business. And retained earnings, again, is the earnings that have been reinvested in the business rather than being distributed as dividend to shareholders. We have the balance sheet equation. The balance sheet equation needs to always hold. On the balance sheet, the total asset will always be equivalent to total liabilities plus stockholders' equity. That is the balance sheet equation. When we add up all the assets and we add liabilities and sum them up with stockholders' equity, there should always be an equivalent. So asset again are economic resources, which means they have future benefits. Liabilities and stockholders' equity, they are sources of financing the economic resources. They are the ways that we finance the assets of the company. The assets could be financed through liabilities, which is money from creditors, or the assets could be financed through stockholders' equity, which is money from stockholders. So this is the accounting equation. Asset is equal to liabilities plus stockholders' equity. This is really a sample of a balance sheet. When we develop a balance sheet, or if we look at any good balance sheet, on the top we'll always have the company's name. So in this case, Lean Natures Incorporated is the company we are looking at. Immediately after the company's name, we'll have the name of the statement. So in this case, this is the balance sheet. And then below the balance sheet, we'll have the point in time. So notice it is at December 31st, 2012. At December 31st, 2012. So that is the point in time. So this balance sheet is a snapshot of this company as at December 31st, 2012. This is going to differ from other financial statements we are going to see. Statements like income statement is going to be a statement that reflect happening for the entire year, but the balance sheet is just at a particular point in time. We have the unit of measurement. So this statement is the figures we see below. They are in millions of dollars. Then we have now the assets. Again, we sum all the assets. Below the assets, we have our liabilities. We sum up the liabilities. We have total liabilities. Then we have stockholders' equity, which comprises common stock and retained earnings. We sum them up. So when we take total liabilities plus total stockholders' equity, what we find is that it is equivalent to total asset. So again, the balance sheet equation holds. So the balance sheet equation states that total asset is equivalent to liabilities plus stockholders' equity. We move to the next statement. The second statement is the income statement. The income statement is going to tell us whether the company is profitable or not. The income statement is going to capture the revenues, and the income statement is also going to capture the expenses. So how revenue is earned. So for this company, revenue is earned through sales, fees, interest, rents. So accordingly, we have sales revenue, fee revenue, interest revenue, rent revenue. So the income statement will have the revenue, and then we are going to subtract all the expenses to know whether there is a net income or a net loss. So expenses will include things like cost of goods sold as an expense, wages expense, rent expense, interest expense, depreciation expense, advertising expense, insurance expense, retail expense, repair expense, and income tax expense. We'll look at an example. So an income statement, again, will have the name of the company like before. The name of the statement needs to be clearly stated. In this case, this is income statement. And then what we find is that unlike the balance sheet that had at December 31st, 2012, this income statement is for the year ended December 31st, 2012. So the income statement gives us the revenue and the expenses that have occurred over the year 2012. And then we have the unit of measurement. So in this case, it is in millions of dollars. So we have the revenue. So for this company, revenue is generated from sales. We have sales revenue. Then we have expenses, cost of goods sold, selling, general, administrative expenses, interest expenses. So when we take the revenue and we subtract all these expenses, we take the revenue minus all these expenses, we end up with income before taxes. Income before income taxes. Then we less the income tax expense, we end up with the net income. So for the year 2012, the company makes a profit. So this is net income. It is positive. It is not net loss. So if this was negative, then we'll call it net loss. And that will suggest that the company made a loss for the year 2012. We also have the statement of stockholders' equity. It has two major elements: common stock. Common stock, again, is the finance that has been invested by the owners, and then it has retained earnings, which is the earnings that has been realized but is retained by the companies, held back, is not distributed as dividend to shareholders. Retained earnings is affected by net income and dividend. So for us to know the retained earnings, we need to start with the beginning retained earnings, and then all income that was made, the net income that was made over that year, is added. So net income increases retained earnings. We need to subtract the dividend that was paid within that year. So dividend is going to reduce retained earnings. So beginning retained earnings plus net income or net loss plus or minus dividend is going to give us our retained earnings. We look at an example. So this is a very basic example of a statement of stockholders' equity. It will have the name of the company, Lee Natures Incorporated. The name of the statement, in this case, is Statement of Stockholders' Equity. It will have the period is for the year ended December 31st, 2012. So it covers changes in common stock and retained earnings from January 1st up to December 31st for the entire year, up to December 31st, 2012. And we have the unit of measurement, which is in million of dollars. So when we look at the common stock, we see that for this company, there is no change. The company ended December 31st, 2011 with about 55.7 million in common stock, and there was no addition. So the company ended the year December 31st, 2012 with 55.7 million. But we find a change in retained earnings. At the end of 2011, retained earnings was 43.1 million. In 2012, the company realized a net income of 22.9, so that is going to increase retained earnings. But the company also paid dividend of about 2 million, so that is going to reduce retained earnings. So this net income comes from the income statement, is going to increase retained earnings, and then this dividend will less retained earnings, and we end up with 64 million. So that's the statement of retained earnings. The last major financial statement is the statement of cash flow. The statement of cash flows have three major elements or three major categories. It actually shows cash flows from operating activity, cash flow from financing activity, and cash flow from investing activity. Again, the three categories: operating, investing, and financing. We need to know that each of these three cash flow sources can be positive. So if it is positive, it is a net cash inflow. Money is coming in. If it is negative, it is a net cash outflow. So money is going out. If more money came in through financing activity than it went out, then we'll have a positive amount for cash flow from financing activity that suggests that money came into the company. So this is a perfect example, a brief example of statement of cash flow. Again, we have the name of the company, Lee Natures Incorporated. The name of the statement needs to be clearly stated. Statement of cash flow. The period needs to be stated for the year ended December 31st, 2012. So the statement of cash flow reflects happening for the entire year, the unit of measurement in millions of dollars. So we have statement from operating activity, which is positive. So more came in from operating activity than it went out. Cash flow from investing activity, it is negative. So the company invested more. So more went out to investment compared to what came in. And of course, more came in through financing activities. So it is positive. So when we add all of that, and we also add the balance that we had from the previous year, we are going to have the cash balance at December 31st, 2012. There is a relationship among these financial statements. The income statement is actually related to the statement of cash flow. The net income from the income statement is moved into the statement of cash flow because it affects retained earnings. Retained earnings is increased by net income or by the profit from the income statement, and of course it's reduced by dividend. But what we see as a relationship between the income statement and the statement of stockholders' equity is that net income moves from the income statement to the statement of stockholders' equity. Also, the balance of retained earnings on the statement of stockholders' equity is also placed on the balance sheet. So on the balance sheet, we have the liability and stockholders' equity side. So the retained earnings amount that we find on the balance sheet comes from the statement of stockholders' equity. Then there is also a relationship between the statement of cash flows and the balance sheet. The statement of cash flows is related to the balance sheet. So the cash at the end of the period in the statement of cash flow is moved to the asset side of the balance sheet. Something we need to also emphasize is that for most financial statement, there is usually a footnote at the bottom of that financial statement. These footnotes are always important for us to look at them. It carries sensitive information. So sometimes when people take a look of the financial statement, they tend to ignore the footnote. Footnotes usually carry information. Three types of footnote. You will have description of accounting rules that is applied. It will have additional details about a line item on the financial statement, and it will also have additional financial disclosure about an item that is not listed on the financial statement. So when we pick up any financial statement, we should note that the footnote also have important information, and it is an integral part of the financial statement. So these are the four major financial statements that we have looked at. So the first is the balance sheet. It's a statement of the financial position at a particular point in time. The balance sheet reports the financial position of the company at that point in time. That financial position will cover the asset, which are economic resources. It will cover the liabilities and stockholders' equity, which are the sources of financing of the asset, how companies get money to finance their asset. We also have the income statement. The income statement, or what we call the statement of earnings or the statement of operations. It reports the primary measure of economic performance during the accounting period. So the income statement will tell us whether the company makes a net income or a net loss. It will show all the revenues less all the expenses. If the revenues are greater than the expenses, then the company makes a net income, which is a profit. On the other hand, if the expenses are greater than the revenue, the company makes a net loss. The third statement that we looked at is the statement of stockholders' equity. It reports changes in the company's common stock and retained earnings during the accounting period. And lastly, we spoke about the statement of cash flow that reports inflows, which are receipts, and outflows, which are payment of cash during the accounting period. And it is placed in three categories. So it is inflows and outflows from operating activity, inflows and outflows from investing activity, and inflows and outflows from financing activity. We need to take note that there are rules that are put in place to develop the financial statements. In the United States, the rule that is used by companies is known as GAAP, which is the generally accepted accounting principles. So GAAP is the generally accepted accounting principles. So the numbers that are in the financial statement, they are developed based on GAAP. A brief history about that: it was actually put in place sometime in 1494 by an Italian monk and mathematician, Pacioli. He actually published a double entry bookkeeping. Prior to 1933, management of most companies were largely free to publish or develop their own financial report in their own way. So the problem with every company doing their own financial report their own way is that there is no uniformity, and in the absence of uniformity, we cannot do comparison. So comparability is difficult. So the accounting rule GAAP that is put in place helps us to be able to compare two or more companies. So this rule was put in place through the help of the Security and Exchange Commission that work with a professional accounting body. The Security and Exchange Commission is an act of Congress. In fact, in 1933, Congress have established what we call the Security Act, and then in 1934, there was the Security and Exchange Act. In fact, the Security and Exchange Act actually formed the Security and Exchange Commission, and Congress gave this body the broad power to determine measurement rules for the financial statement. So the Security and Exchange Commission actually work with an accounting professional body on the detailed rules that becomes what we call the generally accepted accounting principle. So the body that they work with is the Financial Accounting Standard Board. So the Financial Accounting Standard Board is recognized as the body that formulate GAAP. So they work with the SEC, the Security and Exchange Commission, to come up with the generally accepted accounting principle. And as we have said, this is important because it brings uniformity, which makes comparison possible. Investors always want to compare between two companies, so these companies must have the same role in preparing their financial statement. It's actually the responsibility of the company to prepare their financial statement in accordance with GAAP. They incur the costs and they bear different consequences after they publish their financial statement. It has an effect on their stock price. So as we know, when companies tend to do well, stock prices appreciate. So when they publish their financial statement, if it suggests to potential investors that the company is doing well, there will be an appreciation of stock price. If the financial statement suggests that the company is doing poorly, then prices are going to fall. So when companies publish their financial statement in accordance with the generally accepted accounting principles, it has an effect on the selling price of the stock. It also has an effect on the amount of bonuses received by management and other employees, because those are the statements that will suggest that management is doing well or not. So for most companies, there will be compensation on management for a job well done. So that is done after the financial statement reflects a good performance. There is also the loss of competitive information to other companies, because these are publicly traded companies. They need to disclose their financial statements. So unlike sole proprietorship or partnerships that don't have such government regulation that warrants disclosure, public companies need to disclose their statements in accordance with GAAP. So they end up losing the competitive information advantage that other companies have. So in the United States, the financial statement is developed based on GAAP. Internationally, is another rule that is put in place, the International Financial Reporting Standard. So companies abroad actually use International Financial Reporting Standard. And the US has been working hard to move from GAAP to International Financial Reporting Standard. It's very important in any beginning accounting class to emphasize the need of ethical decision making. As you know, one of the profession that has very high temptation to behave unethically is profession related to finance and accounting. Whether it's through fraud or cooking the books or manipulating figures or embezzlement or stealing companies' finances and resources, we are always called to make decisions that are ethical. And the 3 steps towards arriving at an ethical decision is always to identify the benefits of a decision. Before we make any decision, what are the benefits? Who are those that will be affected? Will it harm employees? Will it harm the owners? Will it harm creditors? Will it harm the environment? We need to identify the benefits and the disadvantages of our decisions. And we need to also identify alternative course of actions. What are the alternatives that we have? And we need to choose the one that we would like for our families and friends to see reported on the local news. So we are always called upon to make ethical decisions. To ensure the accuracy of the company's financial information, there are 3 things that are usually put in place. Management wants to ensure that they maintain a system of control. There should be a system of control. Is money kept in a safe zone? Is there monitoring and things like that? If cash is not well managed, it's going to disappear. Management also need to hire external independent auditors to look at the financial statement. So external financial auditors, independent auditors need to be able to sign as to the fairness of the financial statement. And of course, companies also need to form a committee of the board of directors to review these other 2 safeguards. So there's always a board of directors that look at system of control and look at the work of external auditors. External auditors perform what we call an audit, which is an examination of the financial report to ensure that they represent what they claim, and they confirm with the gap. They confirm with gap. And the external auditor needs to overall be able to sign that they believe that the financial statement are fairly stated. If they think otherwise, then they will state otherwise. So it is required that every publicly traded company hire external auditors that look at, that audit the financial statement of that company. Those that have actually falsified financial statement, presented misleading information, is against government law. So sometimes they end up with prison tally. We've had people that have gone to jail for about 4 years because of fraud, and some have even gone to jail for about 20 years because of fraud. All right. There are three basic types of business entities, business organizing. If we form our own business and we need to register that business with the government, or either have our business registered as a sole proprietorship or as a partnership or as a corporation. A sole proprietorship is a business that is owned by a single individual. You are in business by yourself, for yourself. That's a sole proprietorship. So you register your business with the government as a sole proprietorship. There is also a partnership which is owned by two or more individuals. Two or more people come on the table and they put resources together to start their business, and they register that business with the government as a partnership. Then we have a corporation. With a corporation, ownership is represented by shares of stocks. So people can buy ownership of that corporation by buying shares of stocks. Most businesses in the United States will start as sole proprietorship and partnership because of the ease to start. Corporations have a lot of paperwork to be done, hiring of lawyers, accountants to prepare the financial record, listing the company on the stock exchange. So it takes a lot to register your business as a corporation. But even though most businesses will start as sole proprietorship and corporate and partnership, sometime later they always want to at least have the benefit or the move into having their business registered as a corporation. And the reason is because of some major advantages of a corporation. The first is what we call limited liability. A limited liability, which simply suggests that the liability of the owners is limited just to the business. It's limited to what they have invested in the business. So in the case of a lawsuit, for example, if you are a shareholder or the owner of a corporation, the maximum you can lose is the amount of money you have invested in that business. Your personal worth will not be affected. That is in sharp contrast with a sole proprietorship. Sole proprietorship and partnership, they are exposed to unlimited liability. So unlimited liability implies that their personal worth is being exposed. In the case of a lawsuit, claim can be made on their personal worth, their homes, their cars, whatever belongs to them personally. So a major advantage of a corporation is limited liability. Another advantage is continuity of life. A corporation is assumed to be there forever. And the reason for that is because there is a huge separation between owners and management. So those who own the company, they tend to hire professionals to run the company on their behalf, to run the corporation on their behalf. So for most sole proprietorship, the business will come to an end with the passing away of the sole proprietor. But for corporation, the business continues, so it is assumed to be there forever. So there is continuity of life for a corporation. Another advantage of a corporation is the ease of transfer of ownership. It's easy to transfer ownership. When you want to buy into a corporation, you can easily buy shares and you can walk out by selling your shares. So there is the ease of transfer of ownership. Another major advantage is the opportunity to raise large amount of money. As a corporation, if you need more money, you can simply sell shares. When you sell shares, you raise a large amount of money. So sole proprietorship don't have this kind of advantage. They cannot sell shares to the public. A major disadvantage with a corporation is what we call double taxation. So they suffer from double taxation. If you think in the perspective of a shareholder, when the company makes profit, the corporation makes profit, they pay taxes to the government. When the corporation in turn extends money to shareholders as dividend, those shareholders pay taxes. So from the perspective of the shareholders, they are the owners of the corporation. The corporation makes profit and pays taxes. The corporation pays dividend to the owners. The owners pay taxes. So we say the corporation has as a disadvantage double taxation. So that is different from sole proprietorship and partnership businesses. When they make profit, that is regarded as part of their income tax, and they pay income tax. So they pay one tax on the profit they have made. As we wrap up this chapter, it's important for us to note that there are lots of opportunities in accounting. Those who specialize in accounting, they can work with different jobs. They can do public accounting. With public accounting, they are engaged in auditing and assurance services. So they help businesses to audit them, and they help with assurance of businesses. There's also management consulting services for those who specialize in accounting, and there is tax services. They can help with preparation of taxes. So those who specialize in accounting, they can be engaged in public accounting. They can also get employment with organizations. They can work as internal accountants. They can work with external reporting. Internal reporting, they are helping in preparing managerial accounts. External reporting, they are helping to prepare financial report. They can help with tax planning and various other functions. Opportunities for those who specialize in accounting is in almost every organization you can imagine. Public organizations, not-for-public organizations, not-for-profit organizations, they all require accountants. There are certain designations for professionals in this field. So there is the CPA, which is Certified Public Accountant. They take an exam to become CPA. There is CMA, which is Certified Management Accountant. And lastly, there is CIA, which is Certified Internal Auditors. Thank you. Bye-bye.